mortgage rates had shot up to around 20%. I think I have PTSD from some of that, from back in the day.
We do too.
We do too, actually, yeah.
Was there any time when Parks rent went down?
I don't recall Parks ever going down. We went from trailer trash to the darling asset class.
I love that.
I feel like we just keep getting purtier too, Dee Ali is joining us today. Welcome to the Cash Flow Quest podcast. We're excited to have a manufactured housing, influencer with us, a guy that runs panels and has a bunch of fun in the industry. And we've known now for a few years since we've been having San Diego events. So we're happy to, meet you over the last handful of years and get to know you a little bit. Super fun. He's an avid cigar connoisseur. And so we've had fun with that. And
as a matter of fact, we're gonna light one up right now.
Got one right here.
Right. Yes, we are ready.
We're ready.
So I'm really excited to kick around the space with you. I was reading kind of your episode angles and why you stopped chasing hot markets and everyone's waiting on the Fed and here's why you shouldn't. And some cool talking points, which I appreciate. This is an uncorrelated asset, and it's really nuanced. And so you really do have to jump in and understand how to operate mobile home parks. And so I was really interested to kind of pull back the layer and a couple layers of the onion with you on your operational background. You've raised a fund, maybe several. And so I'd love for people and our listeners, most of them are our clients. And we kind of do this to share intel from the manufactured housing space, but then also show that this is the real world. There are a bunch of other people chasing deals. We all kind of tend to have our own niche. We like Arizona. Looks like you like California for the most part. So share some of your story and how'd you get into the space and why you like it and kind of what you're doing now.
Yeah.
Sure. And I'm going to say on the outset that I can be politically incorrect at times. So we're just going to have to run with it. And hopefully your audience can enjoy that. I'm 8th generation in commercial real estate. And it's not because I've been reincarnated 8 times and lived through all of that, but frankly, going back to the bartering days in India, my family has been in what I would consider the first form of income property, in that we weren't farmers, we didn't have any product or service other than land, and we provided that land for other farmers and people who were bringing products and services to bring their goods there and essentially barter. And what you would maybe consider the first bazaar or flea market in modern terms, and so that was that was our income. That was how we got our rice and grains and whatnot. And since then, it's just been always about the mindset of having land as an asset, land banking, and then while you have land, generating income, right? Mm-hmm. So at the very bottom layer, I think we all understand that that's the premise of the business that we're in. And maybe at some point there'll be a higher and best use for that land. Who knows, other than manufactured housing, the politically correct term, as your audience may know, instead of mobile home parks. And I'll use them interchangeably as we go. But fast forward to 1981, July 1981, just before that, in the late 70s, kind of like what we're going through today, we were at war with Iran, and there was an oil crisis. And I remember as a kid, my father only being able to get gas every other day based on your license plate number in California. And, mortgage rates had shot up to around 20%, 18 to 20, 21%, which sounds absolutely crazy, and it is, but, it's happened. And at that time, we had about 120 single-family homes in the portfolio in Orange County, and through the 70s and the late 70s. And by 80 or so, that all blew up. The 120 homes, which I would imagine today would be worth at least $1.5 million on average per home, just blew up like a deck of cards, really like a house of cards. Because nobody was able to get a loan, nobody was able to pay rent, nobody was able to refi, or all those things were trapped, and my father was trapped. And it was a quick liquidation, long story short, which actually was a huge blessing in disguise. We went from about 120 homes in Orange County down to probably about 30 that he was able to salvage. And from that, he was able to save enough for a down payment on his first community. And July 9th, 1981, I became KOA Joe. That was my name through middle school and partly through high school, because the previous owner who owned KOA, his name was Joe, and we were the new owners, and I just declared that I'm the new Joe here. Forget about my name, my confusing name, just call me Joe. And all of a sudden, I became KOA Joe, and that was really early, but what we learned from that RV park, which we started with, was that, hey, this is seasonal. And we were getting fat in the summer and pretty lean in the winter, and that was not a good experience. So we discovered that having permanent residents in some of these rows where we could attract seniors or construction crews or other people who were already open to the idea of living in tiny spaces, which has now become popular. But back in the 80s, it wasn't so much. And it was a niche. And so we were able to establish reoccurring income month after month with permanent residents in many of our pads this way. And that's when we decided, okay, we really want to migrate we don't want to be in the hospitality or a business that's seasonal. We don't really want the headaches of a real retail operation. We want stable, steady income, reliable income from the most affordable asset class, affordable housing, solution out there. And we migrated from the RV park model to the mobile home park model, and never looked back as a family. So that was 1981, and today, we've touched thousands of units, mostly as a family office, all in California. I have personally done some investments outside of state, but and certainly open to that. We could probably come back to that. But anyway, the journey has been incredible because we had built this before there was agency financing, before there were a lot of lenders or brokers or appraisers, and before we really became, I think, a true recognized asset class. I like to say we were, we went from trailer trash to the darling asset class.
I love that
You're
slogan.
Right.
Yeah,
you are right, and I feel like I feel like we just keep getting purtier too. Like
I'm sorry?
We just keep getting better and better looking from an asset level perspective.
Yes.
Like,
all of a sudden I'm pretty, right? And everybody wants to be you and I and in this space, which is wonderful. It's great. I mean, the more the merrier. It's actually brought a lot of great things to the industry. So, I know a lot of people have a fear of saturation and competition and those things, but we just at Rice 360 Ventures, and our philosophy is an abundance mindset. So. We're not afraid of that. There's so many ways to skin the cat, so to speak, in this business. There's so many different profit centers and business models and ways to improve. So, anyway, I could keep going.
No, I couldn't agree more.
On the historical journey.
I'm interested. We look up to you because we started in the 2009 era. So kind of as the country was rebuilding from the GFC or the Great Financial Crisis.
Yeah.
Was there anything you saw that you could share with us and glean as like a history lesson learned, something that you now use every day to look at deals, certain limitations or risk that you don't do? Yeah, I'd just be curious, because you lived through it all through the 90s, and since you saw probably ELS and Samzel build their portfolio all over the country. Sun probably, as a second gen took over. Those are big companies, and so you got a vantage point that I didn't have, So I'd love to glean any lessons you learned along the way.
Thank you for asking. So I'll just say a couple of general things first, if I may. That down cycles, as you guys probably agree and understand, downturns or in the economic cycles or whatnot are generally, and I don't wish ill on anybody in terms of economic consequences and as a consumer, it's very frustrating when you see your latte go from, $5 to $10 or what all the crazy things we're going to see going forward. I mean, I may be paying, $17 pretty soon here in California for a latte. But, as ridiculous as that sounds. The reality is in our asset class, every down cycle has actually been a great opportunity for investors who are prepared and able to take advantage of the opportunities, because what happens, and especially what we're looking at now, I don't mean to preach doom and gloom, but so to answer your question, we've seen several cycles, as you said, from that early 80s to what happened, even with the savings and loan crisis. I don't want to forget that. That was also a huge debacle back in the day. Then the dot-com bust, and of course '08 and 2020 with COVID and all. So we've seen several cycles, and all in all, I would say that when when lending tightens, that opens up the door for more creative opportunities, because unfortunately, what are the D's, the death and divorce and all these kinds of life consequences still happen, right? And people need to liquidate or sell for whatever reason. And when financing isn't available, when the herd is sidelined, it's for those who are willing to be creative and strike the right balance. Bless you.
Thank you.
Between financing and terms, between price and terms and structure. It's those who can get creative and are willing to take the risk who actually get the greatest reward of it. And so I've just grown up, in an environment where we embrace, those kinds of opportunities, distressed situations, and lean in during those times.
Along the way, you had to transfer. There is still seller carry, financing that has taken place in our industry. Back when I was starting, that was more prevalent because unless you had like institutional quality assets, lenders were really gun shy at that time. So we had to find like little local banks that knew the location of the park. And so I kind of lived through that and kind of cut my teeth on deals that were of that quality too, lower end $1 million, $2 million deals. And
yes.
So was there, sorry, I'll back up just for fun. The early 90s in the savings and loan crisis, that almost broke my dad and his construction business. I'll never forget that story because they almost lost their house over that.
Yeah.
Sure.
And so did Parks do fine through that? Like, was there any time when Parks rent went down?
I don't recall Parks ever going down, right? Because I think what happens is when the economy takes a hit like that, and everyone comes down a notch in their lifestyle, so to speak, those that have to come down, we're at the last stop if you really still want to enjoy the American dream. If you want to own a home and you don't want a shared wall, you want a backyard, maybe be able to have a larger pet or whatnot, you want those independent and those freedoms of home ownership. We're the least expensive, most affordable option. So we always saw actually an uptick.
Okay.
In these cycles.
So you actually did see an increase in demand.
Absolutely. So that's that's why we're never really bearish in these markets. We're typically ready to go and aggressive.
Yeah, no, it's just good to hear because I mean we've had the theory, we felt it now. We throttled right through when we first started, just doing like little rent increases or getting to market rents in the 2010 to 2015 area, that time, and it seemed like no problems. And then I say for the first time we're really testing the theory, but then we're having some of the largest percentage rent increases now that we've ever experienced. And it was just because the market kind of ran on us, and then we bought some deals that were cheap, significantly cheap, compared to market rents. And so we're seeing that real time now, but I was always curious if it went back, into the 80s or, 80s and 90s. So it was just fun to hear that. It's always been kind of time tested.
Sure. I think you heard me say it at IMN. My mindset is when people ask me when's the best time to buy a park, and the answer is the same as when's the best time to plant a tree.
Yeah.
Now.
Yeah.
Or 10 years ago. Yeah.
The best time was 10, 20 years ago. The second best time is now. Right. So regardless of what's happening with interest rates or otherwise, I mean, we've just seen this proven over and over.
What markets do you like? So you made I was just reading some of your, kind of who you are off your website, some of your talking points you've had. And what do you see in the market? What are hot markets to you right now? Or like, what do you stay away from? What's kind of your strike zone or your buy box?
Sure. Let me kind of funnel down to general terms, and then specifically, kind of more specific to me, because I think in general terms it'll help the audience more. Our buy box traditionally and still is in fact secondary or just below secondary markets. I would say I was going to say 5, but even down as low as 3 million to 25 million, and that range used to be higher on the higher end, but up to 50 million or so. But as more private equity groups and other groups come in who are very competitive, the goal is to try and be above Main Street and below Wall Street, so to speak, or below the big boys. And so we've got a niche between 3 to 25 million, really even more, oftentimes 3 to 15 million, where we kind of where we excel. And again, secondary or just below secondary markets, at least 100 units. I would say for someone just starting off, by the way, that a minimum of 50 units. But for us, it's at least 100 units, 2 to 3 star communities. Probably typical to what you hear from a lot of people now, where there's also a value add opportunity, typically infill. We do a lot of that. We've done it well. We've built the vertical out to be able to do that well and have a system since back in the 80s. So we have separate arms for buying homes wholesale and selling them retail, and then financing the homes. And of course, asset management is separate and from the real property ownership. So the structure is set up to be able to buy a distressed community. And when I say distressed, it's not just infill, but or at least a community that where you have sellers who are highly motivated for whatever reason. I think what's important is to figure out to be innovative and creative about strategies, right? So everybody is. I think a lot of people are doing infill, and then we're still doing that. It's a great opportunity, but there's other things that we look at in terms of going back to the buy box that ring out. Can you, even with a rent ordinance, can you leverage a rent ordinance to your favor as a landlord? As crazy as that sounds, right? And so, as an example, so we'll look at different value add strategies within that buy box, and if we see something that's unique but still valid, we'll still pursue that. Now, specifically to my organization, what we're doing here, California's been our farm since the 80s. So when you have that type of Rolodex with people who have been in the game before these parks were even parks, they were just land or farmland and converted. I hate to date myself that much, but that's the reality. Some of these families, have carried over generationally and have that kind of history in these parks and communities. And when you have relationships like that over the decades, for someone like me, I can still find opportunities in California. Despite the turbulence and despite the issues with rent control and all the other threats, I can still find compelling opportunities. So yes, we're open to going out of state in those secondary markets I talked about, but only when we need to. Our Rolodex serves us well, and I think with everybody, I say everybody, like anecdotally at least, it seems like most folks. Most Californians aren't investing in California anymore, and most out-of-state folks don't want to come into California. So my mindset is that just leaves more opportunities for the few of us that are here and understand the landscape.
I hear that, and that when there's not a ton of buyers lining up, but there are great deals, and they still pump money and cash flow really well, and there's so much demand here. So I try to keep my finger on the pulse just to see what deals are trading for in at the minimum the San Diego region. And they still trade competitively, but they're not as competitive as like those main markets now that you'd say are red state, big cities in the red states.
It's like the other side of the coin, where if you are having a financial, boom in areas where it's becoming less and less affordable, and our housing option is affordable housing,
right?
Those are going to be markets that will perform even if they have higher levels of barrier to entry.
When you can't bring supply on in California for pretty much anything, like you can, but it's very low volume in
Yeah.
comparison to how many people are here. So like, your thesis is good. So then what would you say so a lot of our investors are the anti-California.
Yeah.
And we fall into that boat as well. More of just like our
Sure.
early thesis. And to your point, we built out our Rolodex in Phoenix, since like the early 2000s. And so we just know it and we keep working it, to your point,
Yeah.
you kind of find your strike zone and you just
Right.
keep going.
Yeah.
But how do you view California? Like the big rent control kind of risk on the horizon is always talked about. I'll ask these questions more openly because I know it's like kind of the main talking
Sure.
points. And then lawsuit risk, I feel like is a lot bigger. Insurance and fire, protection, so basically just insurance now because of those risk factors is becoming pretty expensive. So how do you address those items?
Thank you for asking. It's those are real concerns, and there are real time dynamics playing out still, right? In terms of we're seeing all of a sudden more and more requirements from our insurance carriers or companies. We're seeing more requirements from the lenders in terms of audits of what's happening with regards to improvements on the ground. So it's getting tougher, and it's nothing to dismiss, quickly. And I would agree that California is not necessarily for everybody, right? It's because of the experience in the Rolodex, so to speak, that we can still find opportunities despite this new environment, which it is difficult. But that said, I think everything is always it's all arithmetic. And so let me also jump to a tangent by saying you can't, in my opinion, discount the fifth largest economy of the world on its, fifth largest on its own. People have in the past. I just don't agree with that. The geography of this state it lends itself to the kind of growth that we've seen since it's been formed, right? And you can't deny that. You can't deny what works for California, and that has been proven with multiple industries throughout the land, whether it's Hollywood or agriculture or technology, et cetera, et cetera. So, I'm still very big on California. I'm still big on the opportunity here. And I think what needs to happen at the end of the day is, you balance this demand, this huge need for affordable housing that the state also ultimately has to reckon with and does realize, with arithmetic. You have to, sure, these costs are going up, but then prices or cap rates and terms and interest rates and everything also have to adjust accordingly. So, and to put it in very simple terms, I think it's still very profitable and compelling. It's just that other folks get a little more piece of our pie now versus the community owners. So everybody now knows the secret's out, right? That this is a very lucrative asset class. So in my mind, the government wants more, the lenders want more, the insurance companies want more, and they're all trying to figure out a way to get more of your pie, and they're getting it, right? But it's still compelling in my opinion, and I hope that answers.
No, well
question.
said.
Yeah,
Well said.
yeah.
So then give everyone kind of a broad picture, 30,000 foot. What's your total scope portfolio? Don't have to get into like the nitty gritty if you don't want to, but just like how many units, how many deals? Give me just some overview.
So we have been in the business of buying and selling. I haven't held units, and although that philosophy for the family office, I represent I have two heads. So the family office is kind of going on autopilot, and we've had a great run over the decades, and so we hold a few thousand units there, and we've probably acquired. I don't hold me to the number, but it's close to 10,000 units that we've touched in some way or another in California over the decades. And I want to make a side note about that as well, Blake, if I may, that, I really love to hear people like in the Southeast, for example, and other community owners who talk about thousands of units. And we have to keep in mind, to compare apples to apples. So a unit in the Southeast may go for, especially in the tertiary market, let's say in a small community, might go for as little as $5,000 to $15,000. Maybe $25,000.
Sure.
Right.
Mm-hmm.
And so if you have 5,000 units in the Southeast, it's very different than having 2,000 units at $150,000 on the West Coast that has been built up not through syndication or a fund, but essentially has been built through your own capital and self-funding and some debt along the way.
It's amazing.
So I think, just to put it in perspective, that's a real different. And frankly, I'd rather have 2,000 units that are producing, 4 times as much in rent than to have 5,000 units for the same return, right, or the same numbers. And so, so today we hold a few thousand units in the family portfolio. And what I've done at Rice 360 Ventures is we've just started. We've just actually we've spent the last 18 months just building out our systems and our fund. So the idea is to scale and repeat what I did and what we did with the family. Now bring it to passive investors who also want to get in and but don't have the time and don't want to spend 45 years or reinvent the wheel or any of that stuff, right? So to answer your question, Blake, we have our first community for Rice 360 Ventures, which I'm trying to share.
Oh,
there we go.
That is, I love Weed, California. That's a city, believe it or not, Weed, California. And we just bought.
I love that spin.
Yeah, we just. So we just bought our first community there. It's a very small asset. We did something unconventional there, frankly, and probably unpopular within the community here, within the industry. And just an example of where we're trying to be innovative and think outside the box. And I've been I don't know what's the right word, scrutinized or scolded for this, but from some of the elders, in the space. But we're actually looking and experimenting with this community where we may consider a co-op model, a resident-owned lot model where we ultimately not only fill the community, sell the homes, but also then sell the community to the residents via a co-op structure. Yes, and so again, another out-of-the-box kind of different strategy that may or may not resonate with you all even, but something that we're just kind of experimenting with.
Is the land condo mapped or like parceled into individual parcels, or are you guys going to plan to do that as part of the business model?
It isn't, and we don't plan to. We're aiming for maybe like a cooperative structure, like almost like condos do with, like apartments do with condominiums and whatnot, and create a single. It'll still be purchased by a single entity. If we were to do this model, and it's not certain that we're going to execute this strategy, but it is that's what we're experimenting with. I'm just being very, very transparent and sharing an example in real time of.
That's a good point. I didn't know you could do it. I just hadn't really thought about it
retroactively.
Yeah.
No, without carving up the property
as individual sites.
Yeah. So that's an interesting thing. Mm-hmm. Yeah, they'd all own their share of the company that bought it.
Exactly.
Yeah. Correct.
So why would you do that? Because you could maybe sell each unit for more, like in theory, right? I actually know some guys that have done that in San Diego, where they condo mapped it, parceled them out. They bought them for a big number back in the day, like 100, 150,000 a unit, but then they were able to sell them for 250.
Right.
Yes.
Land was.
This particular community is way up in the sticks up north near Mount Shasta. It's a small tertiary market, and so it's very different than the typical buy box that I talked about earlier. But we're exploring it as an experiment because, and to answer your question, I frankly, and again, I said at the outset I can be politically incorrect.
You're not going to offend anybody here.
No,
but I just if at the end of the day we're eventually going to have all of these communities kind of funnel up to large players, institutional players and REITs and whatnot, if we're all just buying, stabilizing, and then passing it up and they're getting gobbled up, so to speak, down the chain. If that's happening and it's going to continue to happen, I have no qualms and hesitation to have at least a few communities, at least a few homes go to the small guy or gal, right? The small, the resident that and let them have a win. Especially because I'm not a non-profit. I'm not a not-for-profit organization. So let me say that if I can sell it to the residents at a premium compared to what I may exit at otherwise, where the families living there win and I do better, I'm okay with
It's
that.
a win-win.
Because yes,
Yeah.
yes. And so again, I think we should say and be careful that this is not a strategy to be used across the board. It's not something
Sure.
I'm saying is my wheelhouse kind of strategy or whatnot, but it's a one-off. And like you brought up San Diego, we have a large community down there near San Diego, and that's another market that you already have demonstrated that this kind of play may be very compelling, because right now the homeowners are benefiting from our community today, right? Largely benefit in San Diego. And what I mean by that is, for example, we have homes in there that if they were in the Central Valley in California, I don't know how familiar everybody, the audience is with California, but let's say Stockton, California, if that same home that's sitting in space 35 in my community down south, it was in Stockton, it would sell for probably $50,000, maybe $75,000. But because it's in my community in San Diego, where the lot rents are incredibly low because of the rent control ordinances and other reasons, that home sells for $500,000.
Wow.
Yeah, wow.
So my asset value, as you all understand, is being transferred to the homeowner.
Yep.
As opposed to, and so maybe there's an opportunity here to kind of recapture that with this particular strategy.
I think in San Diego, I think you're on the right track. In that's where I've seen and heard it done, where you can get into something. You're still paying a pretty high cap rate, even with rent control, I feel like, in San Diego. But to your point, it's like, if you want it, here, buy the lot from us or buy into this co-op,
Right.
and you guys can own it. And if they can get collective financing, to do it, or however they can pay for it, then you can exit and move your money and make a small premium. But it is what it is, because other than that, you've been trapped. You have equity and returns that have been trapped for years.
Yeah.
Sure. Another angle, and this is also something I haven't done yet, so full disclosure, but I there's a lot of talk of BTRs in the stick built space, right? Built to rent.
Yeah.
And you're finally starting to see some development. That's a tangent as well that I'm not going to go down right now. But you're starting to see some development of manufactured housing communities in states like Texas and maybe Florida. We haven't seen it much in California. I don't expect to see it soon. But I think the point I'm making is similar to, I call it loosely like a BTR model, in that communities like mine in Oceanside or in the San Diego area and others that have communities like that may want to consider a strategy where you actually gradually buy the homes. And as much as it really kind of, it's like a knife stabbing me, because the reason we're not in multifamily, the reason we're not in any other asset class is because we don't want all the typical landlord headaches, right?
Yeah, and maintenance that comes with that. Yeah.
We love all the upside of real estate without all the typical landlord headaches, the termites and the taxes, or the toilets and all that stuff. So as much as I think it would even, raise my grandfather to his grave for him to hear me say this. Like, what are you saying, right?
Yeah.
This is as much as it's against what I've grown up with and what's ingrained. In those kinds of markets, for the audience that's listening where it may be valuable, I would suggest also exploring that exact idea or strategy of gradually acquiring the homes and consider being in that business where you're actually renting the homes out and the land, because that may also be a solution to deal with this. And I don't want to say circumvent, but to address this challenge with the rent control.
Yeah. I mean, hey,
don't hold me to that. It's not legal advice, but it may be a strategy.
Yeah. Well, if you can get, let's say, $3,000 to $5,000 to rent a home, and and you're a dealership, so you can buy homes for cost,
right?
And that you just put tape and textured, higher end home that has more robust finishes. They rent, and they actually, the turnover on our rentals is less than multifamily. In mobile home parks too. typically. So yeah.
By far, right? Substantially less.
Yeah.
We have like 300 or so rental homes that we will put in inventory in bulk, rent them, and then as they turn over, we'll resell them off.
Mm-hmm.
So we've done that strategy just to kind of not have too much for sale inventory at once, you
Right.
know, because it is quicker to rent homes.
Yeah,
So-
and ultimately, like if you're in other markets where the cost to turn a unit is X, it's almost the same in California, but the rent is 5X. So it's
Right.
like it's not as relevant. Where it's like it doesn't usually make sense for some of the markets we're in to just consistently and for long-term rent units.
Mm-hmm.
It would make sense in like San Diego, you know, where it's just astronomical to live.
Yeah.
Yep.
And
yeah, go ahead.
I was just going to say, Ollie, you're not going to offend us in any way. At the end of the day, I would say, and I'll speak for myself, but I feel like you guys feel the same way. We're capitalists first, right?
Yeah.
And as a syndication, we get all kinds of people that come here from all necks of the woods who do different things to make money in this beautiful country. And so, yeah, we appreciate it, especially in our space, hearing creativity. It's like, if you know the rules, only then can you break them intentionally. And I feel like
Right.
that's what you're talking about. It's cool. It's
Yeah.
a refreshing take on it.
Thank you, Ty, for saying that. And obviously, you guys have the same abundance mindset. That's why you've invited me to this podcast, and that's what it's about, right? Sharing ideas, sharing strategies, and
Yeah.
where we all benefit. But you made me think of something, Ty, that if you don't have these words in your vocabulary as you go forward in this economic time that we're about to, that we're entering, if you don't have words like seller financing and all-inclusive trust deeds and wraparounds and 99-year leases or master leases with a triple net structure. So if you don't have these vocabulary terms in your in your box now, I would suggest getting very familiar with these structures, because that's what you should be leveraging, right? Whatever debt you can take on conventionally, okay, great, we should, but understanding these creative structures means that many more deals you can be doing along the way, without tying up your capital or all of your capital.
That's a great take.
Your collateral.
Do you guys manage too? Are you vertically integrated that way?
Yes.
Okay.
Yeah, we do our in-house, all our own in-house asset management and property management.
Okay. Yep. Just like us.
So
Yeah.
we're the same. And what I'm, Ollie, tell us at your peak, what's the most at one time you've had assets under management? Unit count.
No, it hasn't been a lot because we were always in the business of buying and selling. So I would say the highest is what it is now, and it's been about the average, 2,500, 3,000. It hasn't gone much higher than that because we were always buying distressed assets, and again that is changing now for the family. But we're buying, distressed mostly because of lack of, the model that everyone is doing now, right? Infill, mostly because and that works, right? Because the resident typically may not be able to afford all of the upfront costs, right? Now there's financing. We were doing this before financing for homes was readily available and easily available. And so we were also providing the financing back in the day with the CFL as a primary lender with a CFL license. And we still, do that in some cases. But we're not as a primary, but as a secondary. The point is that, I lost my train of thought for a second. The strategy, you asked me how many units, and the goal has always been, hey, this works. We're buying distressed 50-60% occupied units, and the only reason they're occupied at that level is not because of a lack of demand. That's the point that I was forgetting. It's not because of a lack of demand by any means. The affordable housing is always in demand, as we know.
Yeah.
And as you guys have understand, it's that upfront cost, that upfront capital requirement by the resident that wasn't addressed, and still in some ways isn't fully addressed, right? How do you manage the installation costs and the transportation costs and some of those things that aren't always financed, even if the home can easily be financed. And so, and not to mention, by the way, some just real human issues that come into play, like picking out the size and colors and number of bedrooms or whatnot. That's just too many decisions for people when they need a place within 30 days or 60 days, right? And so So if we can provide a 3-bedroom, 2-bath cookie cutter home with easy financing and already placed, ready to go through our vertical, that's the model. I think that, frankly, I think we may have been part of the pioneers that established that back in the 80s, because it works, and it just works. You go from 60% occupancy to 90 or 100% occupancy, relatively quickly. And I don't mean overnight, but relatively, of course, right? So,
Right.
So that model, still works today, right? As we all know. So
We do a lot of the same strategy in that, but then at some point, then it's like, okay, we're now starting to lean towards some of the deals, let's call it dynamics, that have done the best over time, which is that stabilized, call it 90% or so occupied, and we can go in better quality, finish the strategy versus starting the strategy.
Yeah.
Like we've done communities where they're basically 50% occupied, septic, failures, converting to sewer, and to your point, you consume so much cash that when you get done with that, you're kind of tired of the deal and you want to make your money and take your money off the table and move on.
Not to mention the hours it took and the focus and attention. It's both. Yeah.
And now if you stabilize an asset and you love it, then that's another decision.
Great. Right.
But yeah, we've sold a lot too, to your point. We've bought and sold a lot. And then there's certain assets that we capitalize on and that we do want to keep for a long time. And so it's actually been like a kind of a treadmill effect for us lately in the last few years, where we were cycling out of our value add that we've now executed on, and it's time to go towards our future strategy, given the dynamic.
Yeah, and I think that's a good question I have for speaking of future strategy. It sounds like you've been managing and kind of helping with like a family office piece. Why did you guys pivot to like a fund and syndication that way? Like what caused you guys to start that as part of your future endeavors?
Well, thank you for asking, Jennifer. This all kind of, the points that you and Blake just raised kind of all, I think, combine in a way that even in your journey, you noticed you were doing more maybe value add plays, and then decided that, at the 90% level, you might want to come in at a high, with less risk in communities that offer less risk, that have less risk, right? With greater occupancy. And so it kind of reflects on where you may be in the journey, right? We're hungrier early on, and as our appetite kind of stabilizes, or we want to take less risk, we kind of look at those opportunities, and then ultimately you may get to a point where, okay, you've enjoyed this ride and you just want to have that reoccurring passive income, completely stable income, and so you might adjust even further where you're not going into really any risk communities, maybe even, like you said, 90 or 100% occupied. And so I think for us as a family, again, pardon my layman terms, but I think the family got happy and fat and happy. And when we're done. It's been a long ride. It's easy to talk about now while we're a popular asset class and whatnot, but that journey was a very difficult journey.
Oh yeah. I can understand.
You grew long in the tooth, Ollie.
Yeah.
Yes. And so I think I have PTSD from some of that, from back in the day.
We do too.
We do too, actually. Yeah.
Yeah. And I certainly don't mean to discount those who genuinely have PTSD. Forgive me for that. But it has been, we've earned all of this. And at some point you want to just be able to kind of sit back and relax a little bit. And so I think that's what the mindset is for the family, where ultimately we may even have a complete exit. But at 56, this is what I know. This is what I grew up with. And I have dabbled in other things. But at 56, I'm not ready to stop being involved in this industry and in the game. So I started looking at acquisitions myself. I've had a few friends over the cigar buddies, brothers of the leaf, like Tide, who have come to me over the decades and wanted to invest in communities with me. And I've always turned it down. I've always, because for better or for worse, that was just kind of the mindset. Just even at the risk of being smaller and not scaling to tens of thousands of community or pads or whatnot, just wanted to do it on our own. So essentially, I think what it comes down to is the value proposition of investing, right? And where you are in kind of your stages of life and your goals of your financial objectives.
Right.
So for us initially, our model was, hey, we want to build, and that's why we didn't hold a lot of units. We were buying distressed assets. We were maximizing the value, buying at 50, 60 cents on the dollar based on the 50, 60% occupancy, just to keep it simple,
sure.
Right? And then using our strategy to fill in vacancies quickly, and getting to that 95 or 100% occupancy, therefore 95, 100% value, and exiting. And then trading up, using 1031 exchanges the whole way, just trading up into more and more and larger communities, and so that was the strategy. And then all of a sudden, after that whole journey and having, like I said, PTSD from some of those experiences, I think the family finally had reached a level of comfort and security and fatigue, where we decided, okay, just let's get things on autopilot, and then ultimately consider maybe even an exit strategy for the family. And so that's the consensus of the family. But for me personally, I just didn't feel like I was done. I'm not done. At 56, I feel like I still have a lot to offer for the community, for the industry, and wanted to keep going. And so I initially was planning just to do some deals. Like I said, I had some brothers of the leaf, like my brother Tide there, who were adamant, were persistent and wanted to join me. And so long story short, ultimately they won. We ended up, looking at some deals together. And before you know it, if you bring in one or two investors, as you guys very well understand, you have to set up all of the legal infrastructure,
right?
As a syndication and fund and whatnot. So that led us to going from literally 2 of us initially to now 20 in a very short period in terms of our team. And we're just building out the marketing, the accounting, the technology, all of the aspects, of course, the business model, the strategy, the acquisitions, and all of that has come together in the last, technically, I guess, last 18 months, but really more in the last 6 months for Rise 360 Ventures. So we're really excited about it.
Very cool.
Nice.
Very cool.
Yeah, we don't want to lose you, Ali. Like you shouldn't. In Stephen Covey's 7 Habits of Highly Effective People, he talked about there's a lot of people that end up retiring and we lose this wealth of knowledge that the world so desperately needs. There's a lot of young gung-ho entrepreneurs in this country, and but we need people, especially in our industry, that can impart this wisdom, because it's so important. And it doesn't matter how sharp you dress and what school you went to, if you haven't been through multiple cycles and been through those traumatic situations like you have. I talk about rough value add deals are kind of like a fist fight. And so it's easy for young acquisitions people to advise you to get in a fist fight, but if they haven't been there, so never leave Ali. Stay, be a Charlie Munger. Be here until you're in your hundreds and teach us.
Yeah.
There you go. And I'm so fortunate. I'm blessed. I get to take credit and be on the stage, but it really comes from, as I mentioned earlier, 8 generations of teachings, and a father who's really 1 in a billion, not because we come from a country, our ancestry is a billion plus, or not just because of that, but really because of his serial entrepreneurial nature. He's just a serial entrepreneur, and he applied that to this space, and I got to be a sponge, watching someone like him. So, and now I get to share, but it's really kind of bringing all of that knowledge and those principles along the way, and hopefully contributing something valuable.
You mentioned earlier you have kids. Are they interested in joining the endeavor as well?
They don't want to talk to Dad about anything right now. They love this business. They know better. They know better. They're 16, 18, 20. Thank you for asking, Jennifer. So right now they're at the stage where they know better than mom and dad. And, But I think they don't want to. At least they don't voice it as of yet. But I think they're finally getting to a point where they're recognizing, they understand, they're starting to appreciate, the value of money, may I say bluntly, and how difficult it is in society. So they're starting to kind of to see some of that, and I think it's starting to resonate, though they're not ready to voice it yet.
Yeah, I would think your 20-year-olds.
I'm still optimistic.
Yeah, I think your 20-year-old's probably the first one there. Life sort of hits you in the face once you get in your 20s.
Yes.
Yeah.
Yes.
That's
I'm not giving up. And I do have already some of our ninth generation. We're 5 siblings. So,
oh wow!
So there's already a couple of the others that are in the industry now. So we're going in our 9th generation.
Very
wow,
cool.
That's so cool.
Yeah. So is your entire portfolio in California?
Currently, yes.
Okay.
Yes, it
But
is.
you said you're
from San Diego to Mount Shasta.
Okay.
We've been so our farm, so to speak, was always along the Highway 99 and I-5 corridors up and down Central Valley.
Yeah.
That's where I live, so to speak. That's where we've done the most in terms of pads in this space, and continue to focus heavily.
Okay.
Where do you live personally?
Yeah.
I live in the San Francisco Bay Area.
Okay.
Okay.
Yes. I don't know if you're familiar with the East Bay, but I've lived in Alamo and Black Hawk and the Danville area. I'm currently right here at the Bridges Golf Course in San Ramon, California.
Nice.
And so, I've been on this 680 corridor since 93. So we've been here as a family since then, and so this has been base. When my wife and we got married, I told her we have 10 years to go do whatever we want to do before we have kids that need stability, and before we want to be back for the folks. So we took off for 10 years and lived in different parts of the world.
Wow.
But we knew we were coming home, and thankfully 10 years to the month we were back.
Wow.
That's incredible.
Very cool.
What a fun thing, an adventure.
Yeah, so we're here, and the family's here, and it's great to be with them.
Yeah.
So, anyway.
Well, next time you're in San Diego, we'd love to have you by the office and maybe do this again. Have some continue our chats and talk about more sectors of this glorious industry, the mobile home park realm.
And smoke a cigar.
Yeah.
Yeah, I was gonna say if we're gonna meet in San Diego, we may have to meet in Old Town at Churchill's, and there's great restaurants and coffee shops nearby too. So I'd love to host you over there.
Most definitely.
Cool.
Well, thanks, Ali. Appreciate you coming on today and sharing your stories and your wisdom. Have a great rest of your day.
Thank you all very much. Thank you for your time, and to the audience as well. Take care.
See ya.
Bye.
Bye-bye.